Hey guys, welcome back to another video by me, Rylan Trades. In this video, I'm going to show you today how to start day trading if you're a complete beginner and how you could actually become an advanced trader by the time you watch this video the whole way through. So with that being said, guys, we're going to cover a variety of topics today to make you another source of income from trading, basically. So we're going to cover how day trading works, why most traders actually lose money in the markets, and how you can leverage that to make yourself money from markets, what markets to trade, how to find trades, how to read candlesticks, and everything you need to know trading. If you like this video, hit the like button. If you like this video even more, hit that subscribe button, guys, because this is golden nuggets fed to your brain. How does day trading really work? So guys, in simple terms, we want to buy the stock at a lower price to sell the stock at a higher price. When you sell the stock at a higher price, then you're going to gain a profit, okay, when the stock moved up. So basically, day traders profit, guys, when stocks are moving really good. You don't want to see a stock and it just moves a tiny little bit. You want to find a stock that's making good high and lower moves, okay? When there's more volatility in the markets, price will drive higher and lower more substantially, okay, at a substantial rate, which gives us more opportunities in the markets. So we want to profit off these market moves by a small range or a large range, okay? It all is determined by your strategy. So it is our job to have a set strategy to implement trades in the market with our strategy to make money, right? So basically, this is how day trading works in a nutshell. So why most traders lose money, guys? The reason why they lose money is because day trading requires quick action, okay? Once you see a setup based off your strategy, right, you gotta act quick, right, without breaking your rules. So you gotta have quick action and you gotta have a ton of discipline, okay? And not just have discipline in the markets, but if you have discipline in your daily routine, it's going to help you in your trading. So new and existing traders, guys, don't have these things and they don't do these enough. That's exactly why they fail. And another reason is because they become too emotional while they trade. The reason why they become too emotional is because they risk too much per trade, right? And because they are too stressful in the markets, okay? When you're in a trade, based off your strategy, and if you trust your strategy and if you trust yourself because you are disciplined and you make quick decisions, right, you are going to succeed. You got to make sure you don't have no stress or be too emotional in the markets, okay? Some traders actually risk way too much money per trade. So if you have an account value worth $100, you could only risk 1 to 2% of your portfolio. So guys, if I have a value of my account worth $100, okay, if I put $100 into a trading account, I could only risk $1 to $2 a trade. That's 2%, okay? So if you risk too much money, you're going to be more impacted, which then makes people lose money. You got to trade only 1 to 2% of your account, nothing more, nothing less. So what to actually do to succeed in the markets, guys, if you want to make money as a trader? Okay, you got to have a day trading strategy and you got to stick with your strategy. You got to trust it, then build trust with your strategy and not break your rules. Okay, so you cannot be emotional, okay, when you're trading either, because if you're too emotional, then it's going to make you have poor decisions in the market. Okay, and you cannot risk too much money all at once. Again, I talked about this 1 minute ago. I talked about this already. Do not risk too much money. You could only risk 1 to 2% of your whole account. Risk $1. You have a $100 account. That's 1%. Be disciplined, okay? And you got to have a quick action, okay? While you follow your strategy, you got to not break any rules, okay, whatsoever. If you break a rule, it's going to violate your strategy and potentially make you lose a trade. You got to trust it. You got to follow your strategy. You got to be disciplined. You got to have quick action, and you cannot risk too much, okay, as a trader. So that's exactly what to do to succeed. All right, everybody. Now we're going to get into what markets should you trade. let's go ahead and jump in here. So what markets should you trade? There's Forex you could choose from. It's basically the foreign exchange market. It's the largest market in the world. You could trade currency pairs. So you could trade pairs like Euro, US dollar. You could do Forex. There's futures. This is my personal favorite. So there are futures, guys. This is my personal favorite. I trade contracts. So basically in a stock, you buy a contract at a specific price of what the stock is. Then you sell that contract for a more bigger price. So basically, this is what my personal favorite is. I love futures. And should you go with futures too? Yes, I think you should go with futures too as well. But there are other markets to get into too as well if that gains your interest. So there's also indices. Indices market is basically popular stocks combined into one. You could trade. S&P 500 has 500 stocks involved into one stock where you could actually buy and sell from. So that's that. And exactly with the Dow Jones US 30, there's 30 stocks combined into this one stock that you could trade from. And there's also commodities, which is basically trading raw materials like gold, silver, and oil. And also, guys, there's options. So it provides the right but not the obligation to buy or sell an asset at a set price before a certain date. So guys, there's a variety of markets you could actually get into. So with that being said, go ahead and pick one. Again, futures is my personal favorite because you're buying contracts. For me, I started out as trading in Forex. Then I moved to futures. You could do the same or you could do futures starting out as long as you learn a specific exchange market, guys. Okay, so there's stocks too as well. You could trade just normal stocks, individual companies, so like Tesla, Nvidia, Apple, stuff like that. And guys, there's also the cryptocurrency market. Basically, you're trading digital currencies and it's active 24/7 unlike normal markets. So with that being said, guys, you can go ahead and select your market. But again, minus futures, I like going with futures. So go ahead and check these markets out, see which one interests you the most. All right, everybody. So if you want to start seeing the charts, you want to go ahead and go on Tradingview.com. And once you're on Tradingview, we're going to go down to products and super charts. And then boom, now you're in. As you can see, now we're in and now we're looking at the NASDAQ 100. And as you can see, you see all these little candlesticks. It kind of looks confusing, I know, but I'll break this down pretty simple, guys. Okay. As you can see, if we select this, you could see, so you can now see the markets we talked about. So now you got the normal stock market, you got funds, you got futures, Forex, crypto, indices, bonds, economy, options. So guys, as you can see, we're on the charts and you can see all these little green and red things here. These are called candlesticks, as you can see. And these provide us information to give us a bias of what markets are doing and to actually predict the markets in the future. So basically, we want to buy at a small price again and sell at a higher price, maybe here or maybe at a small range here. It just depends of your strategy. So we want to read these candlesticks, and I know it seems confusing right now, but once I break this down, it will be pretty easy to read charts. So let's go ahead and jump right in here. All right, you guys, so I'm going to show you exactly what a candlestick is and what does it tell you. So let's go ahead and look at this green candle here first. So just because it's a green candle, it's going to tell me right then and there the market went up. So what does that mean? The body of the candle is exactly just that line. So what does this tell us? This green. So not only the market went up because it is green, but it tells us that the market opened up right here at this bottom left area and it closed right up here, which then once the candle does that, it highlights this whole area and turns it green. So that's what it tells us. So this right here is our open. This is our open. I'm going to write O for open. And this is our close of the candle right up here. So then it highlights the whole candle and tells you, okay, this is the body of the candle here. It's green because the price went up. And you might be asking, what is the little stringy part at the end? Those are called wicks, okay? Wicks are what price did during that time. So each candlestick refers to a certain amount of time. So this candlestick could be a 1 minute candlestick, it could be a 5 minute candlestick, a 15 minute, and so on. If you're on the 1 minute time frame, these candles will actually signify that each candle was made on a 1 minute time. So price opened up, all right, at 0 seconds. This candle was born Okay, it opened here, and then during that 1 minute, price pushed all the way up here, then it went back down, pushed down here, okay, or vice versa. It went down here, then it went up here, then it pushed down, but then it closed. After the 1 minute, it creates a new candle, then it closes. So basically, draw a line here and here. That's the open and close of your candle, okay? So now let's look at the red one, everybody. Let's look at this red candle here. So the red candle, it actually is reversed. So not only because it's red, what did the market do? Did it go up? No, the market did not go up because it's red. When it's red, the market went down. The price went down during this candle. So again, we're on the 1 minute time frame, which means this candle is based off 1 minute. So it's based off 1 minute. Now what? So this market went downwards. So that means it opened on the top left here, okay? And then it closed down here, as you can see. So it's the direct opposite, as you can see. So that's exactly what candlesticks are. So again, you got the open here and you got the close, okay, of the green candle, and then the open of the red candle and then the close of the red candle. So candlesticks, you guys, on the 1 minute time frame, it's based off the 1 minute. So it's going to open here. Okay, the wicks show you what price did during the 1 minute. Okay, so price went down to here, but came back up and up to here during the 1 minute. But wherever price is at, it's going to close there after the 1 minute. So price looked like it got this high, got this low, came up and closed here. So after the 1 minute ended, it closed here, which made this big green candle. And same thing with the red. So the red means automatically what? Market went down. Okay, unlike the green, if you look at the green candle, the market went up. Okay, red went down. So what does that tell us? The market opened here, right? And then market went up, and then it pushed back down during the 1 minute, which made these little thin lines. Then after the 1 minute was up, it closed exactly where it closed at. So right here, it made the body and then it filled the rest in, as you can see. Pretty simple stuff here. So study this, note this in your notebook if you are taking notes. And this is the open, close, and then open and close of the red candle. So with that being said, pretty easy to recognize. Hopefully you do understand that. If not, go back, watch this portion again. All right, you guys, so as you can see, we're back on the normal charts and we're on Apple for this demonstration. But before I show you this, I do want to show you the time frames, okay, as you can see. So it's 15-second time frame. There's 1 minute, which is blue because we're on it, 5 minute, 15 minute, 1 hour, 4 hour daily chart, and the weekly chart. So as you can see, these are all time frames, okay? So if I'm on the 1 minute time frame, that means each candle is made based off 1 minute, okay? If we go on the 5 minute candle, as you can see, it looks completely different, right? But that's because each candle is made off a 5 minute. So I want to go ahead and look right now. We're on the normal chart. I want you to go ahead and see a candle. So let's look at this one here. What do you think happened? Just tell me right now. If you know, awesome. If you don't know, it's all good because I'm going to go over it. But basically this candle right here, all right, it's big candle. So what does it tell you guys? First thing you got to tell yourself in the head, okay, it's green. That means the market went upward, right? It went up. So how much did it go up by? So at $232, right, and 11 cents right there on the right-hand side of the screen where my cursor is, it opened there, okay? Then price moved on its way up, right, during the 1 minute, right? It went down and up. That's why there's wicks here, okay? Once after the minute is up, then it's going to close wherever it's at. So for this example, it went up, down, right, or vice versa. Then it came right here and closed right here after the minute was up. Then this candle was born. So if you got that right, congratulations. If not, it's all good. You just need some practice. Rewind, maybe watch this clip one more time. And now, once you understand candlesticks, we're going to learn what a trend is. What is a trend, okay? A trend, as you can see, is exactly what you see here. There's two types of trends, okay? Price makes a low. So right here, there's a nice low in the market, okay? So price made a low here. It made a high here, as you can see, this high. then it came down low. All right, guys, so as you can see, we got a low here and then followed by a high. Then the market comes down here, makes a higher low, so it's higher than this one, okay? Then the market makes another high, okay? Then pulls back. The market now makes a higher low, then a higher high. See how the market's doing that? That just shows you that we're in an uptrend. Now, guys, let's talk about a downtrend. Okay, so the recent example was an uptrend, but this time the market's going to go down. Why? Why is the market going to go down? Because look at, we got a high, okay, we got a low. These lows right here kind of equal, so I'm just going to put both of those, okay, and we got a lower high followed by a lower low, and then followed by a lower high. See? And then this is kind of about the same here. This is what we like to call a relative equal low because they're kind of the same here. And then the market makes a lower low. So with those terms, we could identify that this market is in a downtrend. All right, guys, so now you know the two trends in the market, the two types of trends, and you also know how candlesticks open and close. Okay? Now I'm going to show you exactly what a fair value gap is, everybody. So what is a fair value gap? It's going to have to do with a series of 3 candles here, okay? So we're going to look at these 3 candles, and we're going to go from the first candle, okay? There's a 1, 2, 3 candle, okay? We're going to go at the first candle, and we're going to see where the high of the candle is, right? So where's the high of our candle? Is it here? No, not what the body is. What did it do in the first 60 seconds, right? It went to here. Okay, so we're going to go ahead and draw a nice line from that high, okay, through the second candle, right through it like it's stabbing it, right? Price, right, during this candle, it went up to there during the 1 minute, then it closed right here. So we want to mark the high of that candle. So now we're going to do the same thing with the third candle, but it's going to be opposite, okay? So we're going to look at the lowest part of the candle. So the lowest part, there's no wick there, so it's just the body. So I'm going to go ahead and draw the line from that low and stab the middle of this candle here. It's the second candle. Basically, this candle is getting stabbed twice. Highlight that area we just drew out. Okay, boom, now we got this little zone. What does this mean, guys? This is called your fair value gap. Okay, this is a gap in the market, right, that price likes to actually refer back to and use this price point as a zone to bounce off from. Okay, so it's going to come down in the zone and basically tap into this area, anywhere in this area, and bounce off to go higher, okay, right here. So I'm going to suggest that since we're on the uptrend, as you can see, we got a low, right, followed by a high, by a higher low, to another high up here, to a higher low. We could signify that we're in an uptrend, right? And once we do the fair value gap, okay, right here, we're going to suspect that that price will tap into here and continue higher because we're in an uptrend. I'm going to suspect that the market's going to go up here. So let's go ahead and see what happens. So price uses this fair value gap, right? Look what happens. Boom. Then price uses this midpoint. Then it bounces higher. Boom. Look at. Then it goes higher. Then it uses this fair value gap again. Look at. Right? It's using the lower part of it. And then let's see what happens. Oh, and then it bounces higher off the fair value gap. You guys see that? So this is kind of treated, guys, as a support zone. This is a support zone. Okay, this fair value gap is going to be our support. Okay, that makes price go higher. So guys, there's also going to be times in the market when you're looking into trades, right? And there's going to be times in the market when you get downtrend followed by all of a sudden you get this area here. right? This is called a consolidation area. You can't really determine if it's an uptrend or a downtrend, right? Because you have a low here, you have a equal high, kind of these equal highs here, okay? It's not really making a newer high. It's higher than this one. It's kind of just like staying stagnant here, okay? So price is going up and down in this area. Then it breaks the old low here. So basically, we're kind of uptrend, but really we're not because it went a downtrend. You don't really know what the market's doing. It's just kind of back and forth here, just like this. This is called our consolidation area. When there's not a clear uptrend or a downtrend, it's kind of consolidating. This is an area, guys, where you cannot trade at. When price is not making big moves, like what we talked about at the beginning of the video, when price does not make big moves, right, sudden moves, there's no entry for a trade. You're just not going to look at it. We're just going to ignore it and move on and maybe trade the next day when there's big moves like this. Easy to determine, okay? So with that being said, we're not trading consolidation areas, okay? And with that being said, I hope you did like this video. Hope you guys do enjoy, because I am here to help you guys out and to give you the knowledge that you need to succeed, guys. I'm here for you all the way, guys. Okay, remember that. With that being said, hit that like button, hit that subscribe, because I tried majorly hard to work on this video to improve you. With that being said, everybody, hope you guys enjoyed and like this video, because I'm here for you all the way. Peace, guys. Take care and trade on.